Good morning to everyone on the West Coast and good afternoon to everyone on the East Coast. Thank you for joining us today on our webinar on Liquidity Risk Management Program. This is Marty DeZoor of DeZoor Compliance Consulting. I serve as the Chief Compliance Officer for IMST and IMST2. This webinar is a joint effort between MFAC and DeZoor Compliance Consulting. Our panelists today are all from MFAC. Josh will be discussing the timeline and expectation. Max and Evan will be discussing policies and procedures as they relate to the Liquidity Risk Management Program and the actions between the advisor, and Chase and I will be addressing the trust and service provider support. If you have any questions throughout the webinar, please type them in the questions box on the webinar control panel. As time permits, the panelists will answer your questions at the end of the presentation. If we do not get to your questions during the webinar, we will contact you separately. To begin, Josh will provide the timeline for the program implementation.
Thanks, Marty. One of the main things surrounding this new rule is timing. One of the most popular questions in the industry that everyone is asking is, will the new rule and implementation be delayed or not? There's been a lot of pushback from service providers in the industry, and the ICI sent formal requests to the SEC requesting a delay to the Liquidity Risk Management Program. They've also requested to change some of the rules which would go into effect. However, to date, the SEC hasn't addressed any of the concerns about the timing. The SEC did announce in mid-September that they suffered a data breach. This is a concern as it brings into the question the SEC's ability to protect sensitive data that firms will be required to provide under the new regulations. Many say that the SEC needs to implement appropriate safeguards and to be transparent and make the industry feel comfortable before implementing the rule. A new Treasury report came out at the end of October, providing the Treasury's views and recommendations on the rule. The Treasury urges the SEC to scrap the 4-bucket classifications and just focus on the 15% limitation on illiquid assets. They've also urged the SEC to push back these deadlines. As I alluded to earlier, the ICI has also voiced strong opinions with several press releases requesting the SEC to delay. So clearly, there's a lot of noise going on in the industry. In the meantime, we're here to help you. We still need to move forward with this Liquidity Risk Management Program. Even if there is a potential delay in the horizon, we need to work on getting these programs completed and drafted. So until there is more clarification and guidance from the SEC, this is what we have to work with and the time frame we will be focusing on. So talking about the timeline, I really want to start with the end date in mind. That date is December 1st, 2018. You know, it may seem far out, but really it's just over 1 year away with what we're working with. This is the date for the adoption of the Liquidity Risk Management Program and Form N Liquid. This December 1st date is when funds must be in compliance with the rule. The rule requires that each fund's Liquidity Risk Management Program be approved by the board before then. So the question is, how do we get to this completed program at that December 1st date? What I really want the advisors and sub-advisors to do is focus on 2 board meeting dates. The first board meeting date is going to be in the second quarter of next year. At this meeting, the first draft or summary of the program needs to be provided to the full board to review. For our IMST advisors, that's going to be June 2018. For our IMST2 advisors, that's July 2018. The second date is where the final Liquidity Risk Management Program for the advisor and sub-advisor needs to be submitted for approval. Again, I'm going to state the dates since they are important. September 2018 for our IMST advisors, October 2018 for IMST2 advisors. Again, this is when the full Liquidity Risk Management Program needs to be provided to the board for final approval. So the next question, what will the board actually be approving at this third quarter meeting? First, the board is going to need to approve a trust level program. This trust level program will delegate several, and quite frankly, the majority of the tasks to the advisor and sub-advisor. The board will also be approving the summary of the advisor and sub-advisor's liquidity risk management program. Please note that there will be specific parts of the program that the board will also need to approve. The fund may need to designate a highly liquid minimum for the fund. Also, the board will approve the designation of administrative responsibilities to a fund's investment advisor or officers. This is known as a program administrator. Both Max and Evan will dig deeper a little bit later on into the role of the program administrator as well as the highly liquid minimum. So going forward, the board will also be conducting an annual review of the advisor's liquidity program. Right now, it's still being determined by the board, what will work best. We might include this as part of the fund's 15C process, or we might set it at, one specific board meeting once a year and always have it, let's say, at the December board meeting. Again, the board is still determining this, and we'll keep you posted as more information comes out. Next, I'm going to pass it on to Evan and Max. They're going to walk you through some of the important policies and procedures that need to be part of the advisors and sub-advisors liquidity risk management program and what the advisor and sub-advisor really has to do.
Thanks, Josh, and hello, everyone. Our goal in this section is to highlight the important aspects of the advisor's liquidity program. Each advisor is responsible for the appointment of a program administrator. This can be an individual or group. However, the program administrator cannot consist solely of the portfolio manager. The program administrator is responsible for providing an annual written report on the fund's liquidity program to the board. If any changes are made to the program during the course of the year, the administrator will need to promptly provide those changes to the CCO as they are adopted and implemented. The second topic we would like to discuss is the liquidity classifications of the securities within each fund. As many of you may be aware, the SEC has mandated a 4-category classification system based on the perceived liquidity of a security. Max, can you talk about what the advisor should be thinking about when classifying the securities?
Sure. Thanks, Evan. So the advisor may classify the securities at the individual security level or by asset class, so long as the advisor also considers relevant market, trading, investment-specific considerations, and the ability to convert to cash or sell without significantly changing the market value of the investment. So for example, the advisor needs to consider the position sizes that the fund would reasonably anticipate trading and the average volume that is seen in the marketplace to determine if it will significantly affect the liquidity of the investment and if it will change its classification. The third-party tools that we will discuss later will be able to provide this information based on certain assumptions provided by the advisor.
Okay, so that's a good breakdown of the advisor's responsibilities. But Max, what if the fund utilizes a sub-advisor to manage the fund? How would that change the advisor's role and responsibilities?
So in this case, the advisor may delegate the responsibility of classifying the portfolio investments to the fund sub-advisor. The advisor will still be responsible for overseeing the liquidity classifications, and any differing opinions between the advisor and sub-advisor on how securities should be classified will need to be addressed in the fund's liquidity program.
Thanks, Max. One more question regarding delegation to the sub-advisor. What if there are multiple sub-advisors that manage multiple sleeves of a fund?
Well, that's a good question. So the issue I can foresee in this scenario is different sub-advisors classifying the same security differently. So each sub-advisor may classify the same security differently based on different assumptions and methodologies. With that being said, the advisor is responsible for selecting the classification for purposes of the end port filing. So a single security can appear in multiple levels, For example, an investment may be able to be sold or settled partially in 3 days, while additional shares cannot be sold for a longer period without moving the market. So the import filing is something new that will need to be done on a monthly basis, and this is replacing the quarterly NQ filings that you are familiar with. We will be able to provide additional detail regarding the import filing as more information becomes available.
Great, thanks, Max. The liquidity classifications will need to be reviewed and adjusted accordingly on an ongoing basis to account for any relevant market, trading, and investment considerations that could reasonably be expected to alter the securities liquidity classifications. In accordance with the new rules, UMB will be filing Form Import on a monthly basis. UMB will be looking to the advisor to provide liquidity classification information or to confirm the appropriateness of the liquidity classifications if using a third-party service provider. The use of a third-party service provider will be discussed in more detail later in this presentation. So next, we would like to discuss the highly liquid investment minimum and what that means to you as the advisor. The highly liquid investment minimum is the percentage of the fund's net assets that are invested in highly liquid investments. Max, can you please tell us what the advisor should be considering when determining the highly liquid investment minimum?
Absolutely. So there are a multitude of factors that should be considered based on the individual investment strategy and also the portfolio liquidity during normal and stress conditions. The highly liquid investment minimum will be initially approved by the board and then reviewed on an annual basis. It will be your responsibility as the advisor, who is the expert when it comes to the portfolio, to come up with a reasonable minimum, taking into account any foreseeable circumstances that may arise. So short-term and long-term cash flow projections during normal and stress conditions, cash or cash equivalents held in the fund, and any borrowing arrangements should all factor into the determination of the highly liquid minimum.
Thanks, Max. Another question for you. So what does the advisor need to do in the event of a shortfall? And when I say shortfall, what I mean by that is, what does the advisor do when a fund's assets that are highly liquid investments fall below that set minimum?
That's a great question, Evan. So in the event of a shortfall, the advisor's program administrator is required to make specific reporting to the Oversight Committee, who will then report to the board. So this Oversight Committee will be discussed in more detail later in the presentation as well. If the shortfall persists for more than 7 consecutive calendar days, then it must be immediately reported to the Oversight Committee and also to the SEC via a non-public filing Form N liquid. So Form N liquid is also something new, and this will also be discussed in greater detail at a later time.
Fantastic. Thanks, Max. Another key component that you are already familiar with is the limitation of illiquid investments to 15% of the fund's net assets. The new liquidity rule now defines illiquid as anything falling into the 4th category in the classification system. A violation of the 15% limitation requires the advisor to report the occurrence to the Oversight Committee within 1 business day. The board would be looking for you to discuss the extent and cause of the violation and how you plan to bring investments of illiquid securities below the 15% limitation. Also, this violation must also be reported to the SEC immediately via the non-public filing Form N liquid. I would now like to turn it over to Chase and Marty to discuss the assistance and support that will be available to the advisors.
Great, thanks guys. So as Max and Evan provided, they gave a great overview of the components of the liquidity rule and what actions are required from the advisor. So as you could tell, there's a lot going on with the new rule. And to that point, I'll discuss the different types of assistance and support the advisor can expect to receive. The first type of support the advisor can expect will be from the trust. The Board of Trustees will be adopting liquidity risk management policies and procedures. These trust policies and procedures provide a breakdown of what the trust really expects each advisor or fund to have when it comes to their individual programs. It helps provide information on key areas in the liquidity rule, such as appointment of a program administrator, the liquidity classifications, fund reporting, and record retention. Basically, a lot of the points that Max and Evan discussed earlier. In my opinion, one of the biggest benefits of the trust policies and procedures is that it provides a boilerplate or pretty much a template of what each fund's written liquidity program should look like. The trust policies and procedures will also establish a trust liquidity oversight committee. This committee will be comprised of the officers of the trust and the trust CCO. The committee will be responsible for overseeing the trust policies and ensuring that each advisor has adopted and implemented a liquidity risk management program. And since we have Martin DeZura, the trust CCO, on the webinar, I'll let him get into the details of what support and assistance this committee will be providing.
Thank you, Chase. Each trust, IMST and IMST2, will have its own Liquidity Oversight Committee. The Liquidity Oversight Committee for each trust will be comprised of officers of that trust and myself, the Chief Compliance Officer. The committee will have the responsibility to ensure that each advisor has adopted and implemented a written liquidity risk management program in accordance with the requirements of Rule 22E4. We would like those procedures to be part of the advisor's compliance manual or desktop procedures. The committee will also be responsible for communicating regularly with each fund's program administrator as part of its oversight. This will be done with daily interaction between MFAC, UMB Fund Services, and DeZura Compliance Consulting. The committee will also be coordinating liquidity risk management efforts undertaken by the various parties. The Liquidity Oversight Committee will be responsible for coordinating with each fund's program administrator to ensure that reportable events required under Rule 22E2 need to be reported to the board in a timely manner. Relevant data needed in conjunction with the preparation of Form NPORT and NLiquid are delivered to MFAC and UMB Fund Services in a timely manner and filed with the SEC in accordance with the rule. Monitoring the advisor's liquidity classifications and then performing independent compliance testing. Now, the CCO is going to have some responsibilities involved with this, and we're working on those right now. But as of right now, the CCO for the trust will be looking to have the responsibility for working with the Liquidity Oversight Committee to develop standards for determining each liquidity classification. As the CCO, we will review each fund's program administrator to ensure that they have a process for daily monitoring of the liquidity. Also, the CCO will develop testing requirements for the liquidity risk management program to be performed. The CCO will also be responsible to make sure there are in place for investigating and resolving breaches that occur and reporting to the board and the SEC any of these breaches. The CCO will review the fund's program administrator's record-keeping process for keeping copies of the policies and procedures, materials provided to the board, and records of how asset minimums are determined. These items will need to be maintained for at least 5 years. Chase now will address the service provider support.
Thanks, Marty. So as you all know, MFAC and UMB Fund Services work as co-administrators to the trust. And I wanted to talk about how we'll be assisting you, the advisor, with the liquidity rule. First, I'll start with the support from MFAC. So here at MFAC, we take the lead on a lot of different administrative duties, like general fund oversight, regulatory compliance, fund budgeting, and SEC reporting. We also act as the main liaison between you, the advisor, and the Board of Trustees. With the new liquidity rule, there will be a lot of additional oversight and reporting, and we're here to help with all of that. For starters, we'll be updating our monthly compliance monitoring to include a more detailed look into the liquidity of the fund. We'll also be doing more frequent testing of the fund's highly liquid investment minimum and illiquid investments. This will be done in order to notify you if the fund's in danger of breaking one of these thresholds. When it comes to Form NLiquid, the task of preparing and filing this will be delegated to us here at MFAC. I mean, with anything that requires additional oversight, reporting, and of course work, there will be additional costs. As soon as the cost of the new liquidity rule comes to fruition, we'll be sure to inform the advisors. Also, as I mentioned before, we're here to help coordinate between you and the board. In the initial phase of creating your liquidity programs, your client service representatives at MFAC will be providing you with any information on what the Board of Trustees are really looking for in your programs. Also, as Josh mentioned earlier, it's still being determined whether the annual review of the liquidity program will be conducted during your 15C renewal or during another time. Either way, we'll be working with you guys to get you prepared for either scenario. Of course, if there are any new quarterly board reports, we'll be assisting you with these as well. Lastly, as you guys start to create your liquidity risk management program, feel free to reach out to any of your client service representatives here at MFAC with any questions you may have. And like I said, we are co-administrators with UMB Fund Services, and I'll just provide a brief overview of some of the service support they will offer. First, they'll be completing the filing of the monthly import form. Also, since UMB works on the nightly portfolios for each fund, they'll be providing reports on the liquidity of the fund's holdings. UMB Fund Services is also expecting to offer 2 third-party service provider options. The 2 service providers are optional to the advisor, but I wanted to give a bit of information on both. These services will be provided in order to help the advisor classify the liquidity of their portfolio holdings. The 2 third-party service provider options that UMB plans to support will be ICE Data Services, or formerly known as IDC, and Bloomberg. ICE Data Services will provide pretty much a module that will assist in analyzing the liquidity of the fund's portfolio. Using data that ICE already has on the security and a couple different inputs from the advisor, ICE Data Services will help determine the liquidity bucket classifications. And this will be done by assigning a liquidity score to each individual security. On top of the liquidity scores, ICE provides metrics and estimates on the security related to its trade volume capacity, projected future price volatility, and the ability for the fund to exit the position at or near its current value. Also, another great function of the ICE module is that these metrics and estimates can actually be done under normal and stress scenarios. So as Max and Evan mentioned before, the liquidity rule really requires you to look at all these different types of scenarios when classifying the liquidity of your security. The second third-party service provider option will be from Bloomberg. They are also offering a liquidity assessment module, and the program pretty much has the same concept as ICE Data Services. The program will provide insight into the liquidity of the fund's holdings and provide different analytics on each security. I mean, that was just a brief overview of what third-party service options will be offered. I believe a more detailed webinar from ICE explaining their services more in depth will be held at a later time. And again, please do not hesitate to contact any of your client service representatives here at MFAC with any questions you may have. There is a lot going on with the new liquidity rule, and we look forward to helping you navigate through it. That will end it for my section. Next, we'll take a few questions before we conclude the webinar.
Thanks, Chase, for that great detail and overview on how the trust and some service providers will provide support. So, first question we have is from advisor asking, when will the trust policies and procedures be available to us? So I think this question is referring to the trust level program. So those policies and procedures are currently in draft form right now, and they're being reviewed by Morgan Lewis, our fund counsel, and we're getting comments from them. So what we plan to do is provide these policies and procedures to the full board in draft form, just to take a look at, and we're thinking about mid to late January, sometime in February, to provide you the draft form. They probably won't be approved until September or so, closer to when the rule will be implemented. But we definitely want to give you enough leeway. Second question. I'm a small advisor with limited personnel. Who can serve as the program administrator? What if I'm a one-man shop? Marty, are you able to take a stab at that one?
Yeah, sure, Josh. Thanks. At this point, the SEC hasn't given any specific guidance as it relates to a one-person shop. However, the rule states that each advisor shall appoint a person or persons who shall be responsible for administrating and overseeing the fund program with respect to each fund it manages in accordance with the liquidity rule. The rule says that a fund program administrator may be a single person or a committee familiar with the liquidity determinations. But the program administrator shall not consist solely of the portfolio manager of the fund. An advisor may be thinking about outsourcing the program administrator's responsibility, but the rule also states that the advisor may not delegate the program administrator's responsibility to a third third-party service providers, such as a third-party compliance officer. At this point, I would recommend that a one-person shop would consider getting help by forming a committee or hiring an employee to just deal with the program administrator function.
Thanks, Marty. We have a couple of additional questions. So let me read this one. It says, I expect my fund to have almost all of its securities in bucket 1 of the liquidity classification. So it's going to be very highly liquid. Do I need to establish a highly liquid minimum, a highly liquid investment minimum? Evan, Max, I know you guys talked about this, so I'm going to pass this to you.
Thanks, Josh. I'll take this one. So the rule allows a fund that primarily meaning greater than 50% of its assets. It allows a fund that primarily holds assets that are highly liquid investments to be exempt from adopting a highly liquid investment minimum. Also, if a fund is exempt from having a highly liquid investment minimum, accordingly, the fund is exempt from adopting shortfall policies and procedures also. So hopefully that answers your question.
Great. One final question. It is, will there be a cost for ICE? And Chase, I know you went into good detail about the ICE, so if you could provide a little bit more.
Yeah, sure, Josh. So put simply, yeah, there's going to be additional costs. But just as a reminder, using these third-party service provider options will be optional to the advisor. I know UMB is currently working out the details with them, and once that's finalized, we'll give an updated fee breakdown. And I think that looks like that does it for the questions. I'll pass it on to Marty to conclude today's webinar.
Those were some interesting questions. First, I'd like to thank our panelists from FMAC. Also, a thank you to all the advisors and sub-advisors for joining us today. We know that everyone is very busy, and we appreciate your focus on the Liquidity Risk Management Program. We acknowledge that this process will be new to everyone, and we hope we answer some of your questions with this webinar. Remember, the goal of the amendments are to ensure disclosure regarding fund liquidity and redemption practices and enhance fund management of the liquidity risk, which would strengthen the security market and better protect investors. If you have any additional questions, please contact any of the panelists or me. Also, you'll be asked to complete a short survey on today's webinar to help us in conducting future webinars. Thank you again for your time today, and we look forward to you joining us at a future webinar. Thank you.